Hi, my name is Ryan Lichtenfeld, and I'm a member of the faculty at the Mortgage University, sponsored by Midwest Mortgage Capital. Today we bring you our third edition of our Friday Guideline Update with the topic of rental income. First thing we're going to discuss is the documentation requirements that an underwriter has in order to prove rental income. First thing, signed personal tax returns including the Schedule E. The Schedule E is the tax document where rental income is determined. And the second one is much easier and much more self-explanatory, rental or a lease agreement. There's exceptions to those documentation requirements. An underwriter is not going to require a Schedule E if the rental property is not on the Schedule E due to the fact, and this is the only reason, that it was acquired subsequent to filing the tax return. So basically, if an individual bought a piece of rental property this year, they're not going to have a Schedule E in order to give to an underwriter. Income calculations when using the Schedule E. First thing is they're going to look at line 41. This is where it shows the either income or loss that a borrower showed from this rental property. Then an underwriter is going to add back a couple of things. First of all, the homeowner's insurance, the mortgage interest, and the property taxes. The reason they're going to do this is because those are actually going to be debits on the other side of the equation. If we did not add it back into this calculation, then an underwriter would be charging a borrower twice for these expenses. The last thing an underwriter is going to add back is the depreciation. Individuals who own rental property often take depreciation in order to avoid paying more in taxes. That's going to be added back in by an underwriter when figuring rental income. Also, an underwriter is going to do an income calculation when the Schedule E is not available, and here's how that's done. They first of all take the monthly rent, that monthly rent that's obviously listed on the lease agreement. They multiply that number by 75%, and that's how they get the rental income. The reason they use 75% is because they assume that the other 25% is going to go towards expenses. Converting existing homes to rentals. Requirements for this, the first two are pretty obvious, and that's we're going to need a copy of a lease agreement in order to use this income. And again, this is income on an individual who is leaving their primary residence and purchasing a new primary residence. We're also going to need a copy of the security deposit check. The third one that I want to make sure people understand is that an individual who wants to do this has to have a minimum of 25% equity in the property they're vacating in order to use the rental income they're going to get off that property. This loan-to-value ratio is going to be determined in one of two ways. First of all, we're going to take the principal balance and divide it by the original sales price, or we're going to take the principal balance and divide it by the current appraised value. Note that the appraisal must be less than 6 months old. I have to put this disclaimer in there. There's other factors that underwriters will use when figuring rental income that we did not describe in this presentation. There's also times, believe it or not, when an underwriter, for various reasons, will decline to use rental income even though the guidelines laid out in this presentation are met. Basically, I'm telling you, I'm not an underwriter. Last thing I want to leave you with is don't get discouraged. There's many potential borrowers that don't need the rental income, especially the ones described earlier who are vacating their current property and buying a new primary residence. They don't necessarily need that income in order to qualify for a new mortgage. Basically, we just have to qualify them on both mortgage payments, the new one and the old one. Thank you. Again, this is Ryan Lichtenfeld from the Mortgage University, sponsored by Midwest Mortgage Capital. We hope you've enjoyed our third edition of our Friday Guideline Update and that you'll come back to see us soon.